Welcome to Facts Not Forecast, your daily edge in the stock market, facts, insights, and opportunities you won't hear anywhere else. Today, we're taking a deep dive into two tech titans that have, well, delivered remarkable returns. Google's parent company, Alphabet, that's GOOGL, and Meta Platforms, Meta. You've probably noticed their impressive runs. Google's stock is up more than 55% in just 1 year and over 230% in 5 years. And Meta, more than 45% and 200% over those same periods. So with numbers like those, and the Fed looking like it's about to cut rates, you have to wonder, are these gains just the beginning for these tech giants?
That really is the big question, isn't it? A lot of investors are asking exactly that. Are these already huge gains just the starting line? We are talking about mega-cap growth stocks here, and with some reports suggesting maybe even 3 Fed rate cuts by the end of 2025, well, the whole economic picture could be shifting to give them a pretty significant tailwind. So yeah, we'll unpack the recent catalysts, look at the underlying fundamentals, and see how they might be positioned for, well, even more outperformance and what that actually means for you.
Okay, sounds good. Let's unpack this, starting with Alphabet. It's been on an incredible tear, trading around $251, recently hitting a 52-week high near $253, and pushing its market cap over $3 trillion. It's just huge. What exactly is fueling this momentum beyond just, general market excitement?
Well, a really significant recent catalyst, the one that pushed it to those new highs and over the $3 trillion mark, was a favorable court ruling. That development likely gave investors a bit more confidence about Google's dominance in advertising, which is, of course, massive for them. Now, it's important to remember there are still ongoing legal things happening. For instance, Magnite is suing Google over alleged anti-competitive ad tech practices. Google says that's meritless, but, these things are out there.
That's interesting. So if there are still these significant legal clouds, like that Magnite suit you mentioned, how much certainty can investors really take from just one favorable ruling? Couldn't that confidence be, well, a bit fragile?
That's a really fair point. And yeah, any single ruling is just one piece. But I think the market's reaction often reflects a sort of collective sigh of relief. It signals maybe the immediate threats to their core business aren't quite as bad as some feared. Plus, Google has consistently said it wasn't overly worried about its antitrust trials, right? So this ruling kind of bolstered that narrative. It suggests maybe a growing confidence that their main advertising engine can keep running without major disruption from regulation, at least for now.
Okay. Beyond the legal stuff, we always hear about AI. What specific innovation is really pushing Google's story forward right now? Is it Gemini? Or is something else grabbing attention?
Oh, Gemini AI is definitely a key driver. Absolutely. It's central to what some are calling Alphabet's next growth cycle. Sources are highlighting its impact, saying it's fueled by its AI chatbot Gemini's success. And apparently the Google Gemini app surpasses ChatGPT in App Store popularity. It's even been topping the App Store sometimes. So for you, the investor, these AI steps aren't just buzz. They're expected to drive significant revenue growth and improved net margins as they weave through Google's whole ecosystem.
Right. Sounds like AI is really becoming foundational for them. But what does all this mean for their stock momentum and, the underlying fundamentals? How's it showing up in the numbers?
Well, what's really insightful, I think, is how Alphabet isn't just beating expectations, but showing real skill in monetizing its huge user base while also diversifying. Take their Q2 2025 earnings report. It was quite strong. Beat forecasts. EPS, that's earnings per share, came in at $2.31. The expectation was $2.17. Revenue hit $96.43 billion against forecasts of $93.90 billion. And if you look back a bit, Q3 2024 saw impressive 15% year-over-year revenue growth. That was $88.3 billion, driven mainly by strong ads, but also a huge 35% jump in Google Cloud. So for you as an investor, that's not just a big number. It shows Google successfully diversifying beyond just ads. That adds resilience as growth potential. Very important today.
Okay, so beyond ads, where are analysts seeing the next big growth areas for Alphabet? What are the key things that could really move the needle on sales and earnings?
Well, beyond advertising, Google Cloud and Waymo, their self-driving car unit, are often flagged as having substantial future potential. Google Cloud specifically offers that crucial AI infrastructure, the Vertex AI platform. That's really attractive for businesses. You often hear the company described as an innovation powerhouse, maybe even the most undervalued of the Magnificent Seven. That group of top tech stocks everyone talks about. It's also seen as a potential top risk-averse stock position for a 2026 boom. And financially, Alphabet has a very strong balance sheet, holds more cash than its total debt, which was around $28 billion back in 2024. That contributes hugely to stability, resilience. Basically, they have the financial muscle to keep pushing innovation.
It really does sound like these companies are almost printing money, especially with digital ads. But seriously, with this foundation of innovation and financial strength, what key signs would you watch for to make sure these AI investments really translate into sustained growth, not just, temporary hype?
Yeah, good question. I'd be watching closely how they integrate AI into core products, especially search and cloud, and looking for real increases in user engagement, or maybe subscription numbers for Google Cloud, continued strong revenue growth in cloud, definitely, and making sure ad revenue per user stays stable or keeps growing. Those would be powerful signal.
Okay, that makes sense. Now, just as Google is navigating its AI future, Meta Platforms is making equally big, ambitious bets. Let's pivot now. Let's talk Meta. Their stock is around $779, hit a 52-week high near $796, market cap around $1.92 trillion. How are they performing, particularly in that vital digital ad space?
Yeah. Right. Meta, their core family of apps, FOA, you hear it called, that's Facebook, Instagram, Messenger, WhatsApp. It continues to be a remarkably strong performer. Really does.
Yeah.
Now, the sources don't explicitly shout digital ad rebound, but look at the user numbers. Daily active users for their FOA jumped by 60 million just quarter over quarter in Q4 2024. That strongly implies robust ad engagement, right? And therefore, advertising revenue growth. Plus, their Q3 2024 revenue grew an impressive 19% year over year. So yeah, the ad engine seems to be humming along nicely.
We know Meta's making these huge long-term AI bets, just like Google. Can you give us a sense of the scale of their AI infrastructure investment? I saw that figure, potentially $65 billion for AI infrastructure. Wow.
Yeah.
For the average investor, how do you weigh that kind of massive spending against maybe needing more immediate returns? Could it actually drag them down short term? Or is this just a necessary go big or go home thing for Meta?
That's a critical question, absolutely. And their AI commitment is massive. One source indicated Meta's AI capex, their capital spending on things like data centers, chips, can surge, plus 65 Bs in 2025. 65 billion, yeah. This heavy AI infrastructure investment is aimed squarely at improving their current ad performance and pushing into new areas, like augmented reality. Now, could such a huge spend be a short-term drag? Potentially. But Meta is clearly playing the long game here. They seem to view it as a necessary go-big move to secure their future relevance. It's not optional for them, I think. And we're seeing concrete things already, right? Like the AI-powered smart glasses. Sales of those Ray-Ban Meta glasses passed 2 million since 2023. In their Q2 2025 earnings call, their CEO highlighted big AI advancements, talked about the transformative potential of superintelligence, noted Meta AI is now in over 200 countries. So it's strategic. It promises potentially exponential returns later by creating new products and making existing ones much better.
Okay, so not just throwing money around, it's integrated into the core business, the future growth plan. Those are impressive numbers, but what does this huge investment really tell us about their long-term growth path and their overall financial health? Are there any potential weak spots, maybe in user engagement or new competition that could, dampen that optimism a bit?
Well, that's where you look at the analyst consensus. It's currently a strong buy. They're projecting an average price target around $866, with a high estimate even up at $1,086, and their Q2 2025 earnings. Exceptionally strong. EPS of $7.14 beat forecast by over 22%. Revenue hit $47.5 billion, also higher than expected. Forecast suggests maybe 9.1% annual earnings growth, 13% annual revenue growth. High return on equity, too, potentially 24.3% within 3 years. Now, vulnerabilities. Look, user engagement is always key for them, but their family of apps keeps growing so far. Competition is fierce, no doubt, but Meta's sheer scale and how they're integrating AI, that builds pretty significant moats around their business. So for you as an investor, seeing this consistent growth, even while they're spending so heavily, it's a strong signal of how efficient they are and their market dominance.
And how solid is Meta's financial footing to actually support these huge investments, especially if the big payoffs are further down the road?
Oh, their financial health is very strong. Really solid. Meta's short-term assets, about $73.6 billion, comfortably cover both their short-term liabilities, around $37 billion, and their long-term liabilities, $62 billion. That shows excellent liquidity. Plus, crucially, their debt-to-equity ratio is low, only about 14.8%. This financial resilience lets them pursue that bold bet on AI with real confidence. It solidifies their position as a potential compounding machine, where innovation keeps snowballing. They can afford those big upfront costs without putting too much strain on their balance sheet and wait for the strategic wins.
Right. So you've got both Google and Meta looking incredibly strong, robust fundamentals, pushing hard on innovation, which brings us back to the bigger picture. How do these anticipated Fed rate cuts fit into the story for these specific tech titans?
Exactly. That's the crucial link. The market consensus definitely points towards the Fed starting to cut rates, maybe 3 cuts by end of 2025, some reports say. And historically, yeah, a lower interest rate environment tends to really benefit these kinds of mega cap growth stocks.
Yeah.
It just shifts the market dynamics in their favor.
Okay, that's the historical trend. But how exactly do these companies, Google and Meta, with their specific mix of ads, cloud, AI, how did they stand to outperform in that kind of environment? What's the direct link for them?
There are a few key mechanisms, really. First, lower borrowing costs make those huge AI and cloud investments even cheaper, more feasible. It can actually speed up deployment, reduce the cost of building out more capacity. Second, and this is really important, the present value of their future earnings gets a boost. Think about it. Their strong ad platforms, the AI advancements, the fast-growing cloud services, all that future profit looks more attractive today when the discount rate used to value it goes down. Makes the long-term growth story more compelling right now. And third, just their basic financial health. Those strong balance sheets, consistent cash flow. They look particularly appealing, quite resilient when rates are lower. It's a more stable bet than maybe some highly speculative stuff out there. They're just well-positioned, as they say, to use cheaper capital, benefit from any general pickup in economic activity that might come with rate cuts, all while staying financially disciplined.
Okay, so putting it all together then. Given all these factors, the company's strength, the AI push, the potential rate cuts, how might an investor think about using GOGL and Meta in their portfolio? Especially when there's so much excitement, but also maybe some froth around AI in general.
That's a great way to think about it. Using GOOGL and Meta can actually be an excellent hedge against some of those more speculative, maybe smaller AI bets that get a lot of headlines. See, these companies aren't just participating in the AI revolution. They're basically foundational pillars of it. Their core businesses, Google Search, its growing cloud, Meta's huge social media reach and ad platform, these are highly profitable, consistently growing. That provides a really stable earnings base. Then their massive AI investments are strategic. They're deeply integrated into these already successful ecosystems. That offers a more predictable path to growth. Still high growth, mind you, but maybe more predictable than many pure-play AI startups. So for you, including them, gives you that diversified exposure to the AI upside, but is backed by proven financial performance and undeniable market leadership. It's a blend of stability and innovation, really.
That was a really insightful deep dive. Definitely paints a compelling picture for both Alphabet and Meta, their current positions and their future potential.
Yeah, it really highlights how these giants just keep innovating, keep investing strategically. They remain absolutely central to the whole market story, especially with these shifts we're seeing in, monetary policy and just the speed of tech change.
So now we definitely want to hear from you. Do you think Google or Meta stands to benefit more from any Fed rate cuts? Or maybe investors are overlooking another hidden winner entirely, perhaps a smaller, more agile disruptor ready to capitalize. Let us know what you think in the comments, and hey, don't forget to subscribe to Facts Not Forecast.
Yeah, really appreciate you tuning in. Until next time, stay sharp, stay patient, and let the market work for you.